The S&P 500 is working on its second year in a row for back-to-back gains of more than 20%. This is something that we have not seen since 1998 and 1997. And this is why I titled the video, "This Bull Market is Losing Oxygen." Because the higher you climb, the thinner the atmosphere gets and it's harder to breathe, making you want to come back down and get some air. I did find this mountaintop quite funny. It was AI generated. But this looks like 1999, 2007. We had those things, and now we're way up here. But that's not all we're going to talk about on today's Stock Market Brief show. We're going to be giving some very interesting insights that is data coming out from various banks. We're going to talk about the performance of the market. We're going to look at market conditions and how to really travel side of an environment where our air could be thinning. We're going to get into expected moves and talk about some of the big market cap names that actually already reached their weekly implied move. And then we're going to get into volatility, because volatility is signaling something very interesting here too as well. Make sure to subscribe to the channel if you haven't done so already. Let's get into it. All right, people, welcome back to the show. Now, the market, yes, working on back-to-back 20+% years. Like I said earlier, we haven't seen this since 1997, 1998. And then I went ahead and drew out the various other times on this chart where we did see back-to-back gains of 20+%. But before I do that, I understand that it's not the end of the year yet. It's only December 2nd. We have a lot of trading time, and we're up about 26%, right? 26.78% right now, year to date on the SPX. So I went ahead and drew out where can we fall to potentially make this so it's not a 20% gainer. Well, we would have to go from where we currently are at 60.53 and drop down to 57.20-ish, right at about that level, to be lower than 20% all from a year-to-date basis. So quite the big drop. Is it possible? Absolutely, as price has been climbing higher and higher. But I just wanted to map out that level down here just to give you some insight as to where, this would not be accurate data, right? Because we're coming into the year end. Now, like I said, I went ahead and marked out the times where we saw back-to-back years of 20+%. Now, in 1998 and 1997, we actually had a year follow through and almost get another 20% gain. And that's the dot-com bubble where it ended up bursting. And you could see prior to that was 1995 and 1996. So just because we have back-to-back years of explosive moves in the market does not mean that it can't go higher. But I did find it interesting over here. The prior time before that was 1954 and 55. The market pressed a little bit higher, and then we saw quite the decline there, reversing some of its gains before obviously picking itself back up off of its butt. In 1935 and 1936, this was quite the pullback over here. And then in 1927 and 1928, that obviously led to the Great Depression quite some time ago. Coming into almost 100 years ago, people. That's quite crazy stuff. Crazy stuff to think about. Now, I want to go over into some various other charts that were provided by various banks and various other institutions that just provide this type of data. So one of those things was U.S. consumer confidence. And I found this to be quite interesting because this is a sentiment indicator. And this is the percent of people expecting stock prices to go higher, right, in a 12-month period. And we just got a really high reading, one that we haven't seen since ever, right? Above 55%. So usually we're below 50 marker. Sometimes we get above it. We scratch our little head above there. But this is basically just saying that U.S. consumers really are believing that the next 12 months, so next year, we're going to have higher prices. And the reason why I find this to be important is because this can be a potential contrarian indicator. So I found this chart by Cypress Capital, and they managed to draw this out. And I just wanted to display that how we are right over here. This is the net percent of consumers expecting higher stock prices. You can see they drew the line over here, and over here when we reached some pretty exuberant levels. And you can see that when it came into here, the market did coming off. Here, it actually just kind of consolidated sideways for a while, and then we pressed up a little bit higher, but we did end up seeing some volatility return there shortly. And then over here, you can see that we did start to get this kind of megaphone pattern, a lot of volatility for quite some time, where we came in, we went up, we came back down, we went up, and we came back in. So we're coming into a period where we saw an explosive move, right, like we've seen before. So are we going to potentially be entering a period where, like I said, we're running out of or running out of air up here, or the air is thinning. We'll take a look at this sentiment indicator here too as well. We haven't seen this reading since 2016, and then also here in 2018. This is when I talked about it last, I believe, on the last episode. And in 2018, that did lead at the very end of the year going into 2019. We did see quite a bit of volatility pick up. The euphoria meter over here, which is a combination of forward PE, VIX, and bullish sentiment, is also getting a wildly high reading. And you could see times where we kind of climbed up higher before. Boom, right over here, we started seeing that volatility. Even over here, it did lead to some sell side. And then over here, right here, the market ended up pricing up a little bit higher before going into the great financial crisis. If you take a look at single stock put to call skew, now this is interesting because down here is bullish positioning, up here is bearish positioning, and you can use this as a potential contra indicator here too as well, where if it gets way extended up here, it could be the time to go long. But down here in these readings, it could indicate that we could have some consolidations, pullbacks, etc. in the markets. I shared this one from Bank of America on the prior episode, and it was another sentiment reading saying that we're not quite there yet, but we are getting somewhat near extreme bullishness, which could be potentially bearish for stocks. And you can see that that happened at the peak there in 2021. It's happened in 2007. We got way extended from it back there during the dot-com euphoria. This is consolidated equity positioning. I believe this was Deutsche Bank that provided this. I'm sorry, I'm not sourcing all the data, but they came from Deutsche Bank, Bank of America, Goldman Sachs, etc. So I'm pulling a lot of the data from another source that pulled all of that. Okay, so this is consolidated equity position. They use week-to-date average Z-scores, and I just wanted to call out that it's still not extended up into these higher readings, but it is not too far off. So it might potentially have some room to go. Now, if you look at mega cap growth and tech positioning, this one just got a pretty extended reading as of recent. And then also, if you look at consumer staples, this thing is way up here at a pretty high percentile. You can see it's at nearly 1.5, and we haven't really seen that since way back when. And this makes a lot of sense to me because just take a look at names like Walmart, right? If you look at consumer staples, the top three names is Walmart, it's Costco, and I believe it's Procter & Gamble. And Walmart has just seen this explosive move for the year. Costco also explosive move and still consolidating up in these, higher levels over here near and around 1,000. And if you look at a year-to-date heat map, take a look at Walmart. It's at 76% year-to-date. It's beating Tesla. It's beating Amazon. It's beating Google, right? It's beating Meta. It's beating Apple. It's beating Microsoft. It's definitely not beating NVIDIA, but Walmart, of all names, is a top contender from a year-to-date perspective. And look at Costco, it's up 47%. Now, the market is a discounting mechanism, right? The market is all about forward-looking. So is this big run in Walmart and Costco, is it front-running something to potentially happen as we're getting into these areas where the S&P 500 could be potentially in an area where air is thinning out and may need to pull it back? Well, just take a look at something like Berkshire's cash position, how it's surging to new highs. This is interesting because, right, as cash positions grow, what does that tell you? Well, if you were trading yourself and your cash position started growing, it means chances are that you're getting out of the market because there's some sorts of fears that the market may pull in, or that you don't see as many available open or positions that you'd want to execute into to have risk on. So going into a higher cash position typically can mean risk off. There's another interesting indicator called the Buffett Indicator, and what they're doing here, as it's at 208%, this is as of September, it's taking the U.S. total stock market value, which is at the time was 60.86 trillion, and dividing it in its annualized GDP. And this is 29.24. Now, why does it matter, they say, right? The Buffett Indicator expresses the value of the stock market in terms of the U.S. economy. If the stock market value is growing much faster than the actual economy, then it may be in a bubble. Well, what's it look like here if we chart it out? Well, this chart is here by I don't know who, current market valuations. And here it's above a 2 standard deviation move. The last time it was here was 2021, right, where it got very, very frothy, and then it came back in 2022. And then prior to that, you can see over here that we got into a 2 standard deviation move in the 2000s. And both of these times, when we started to come back into the historical trend or come into 1 standard deviation, it started to mark bottoms in various equities and various indices. On top of all of that, I find it to be very interesting that the market has been pressing higher, but CTA positioning hasn't really been playing catch up or as an extended level. So this tells me one thing. It tells me that if CTAs want to hop on board, the market can still obviously have more upside potential. And that's where we got to really dive into conditions of the market and map out some of these important gamma levels. Now, before we get into that, I want to look into the performance of today. The performance today was driven by tech and consumer discretionary, typically more risk on. And you see a big drop in other names that have been seeing some relatively very, very strong movements. Like, for example, utilities was down 2.15% today. And this was one that we called out about 3 or 4 videos ago with some various indicators that we pulled from various banks showing that they were getting very, very extended. If I look at the heat map of the S&P 500, what do you notice? You see a lot of red on the screen, but you see a couple of names that have these higher implied vols really did hold the market up. But I want to map out some of these names, these larger market cap names, and show you that, hey, already for the week, they've reached into their implied move. Now, this doesn't surprise me seeing the Qs take off like this. On the last trading day, or November 29th, I posted this on my X account, and I said, basically, is it gearing up for an all-time high again? Well, this is very simple stuff, right? You have the presidential results, right? We saw this big boost. It came in and it started getting very tight within this contraction pattern. So if I update you today, boom, we broke out of it, which is not a bearish sign. And we did clip into new all-time high territory. If you look more specifically at this ETF, this is the MAG, so this is just tracking the Magnificent Seven stocks. You can see we also consolidated here. It looks very similar to the Qs, and we broke out on some pretty big volume. So these ones could still be ones to watch. You just got to be obviously patient and know where these implied moves or what the forward-looking risk is in the markets. Now, if we take a look at the Qs, if I zoom out back to this contraction pattern we talked about when it was over here breaking out, the measured move of this brings us into and around 550. So if this is going to be breaking out, I mean, this still opens the door to potentially higher prices if the market wants to go higher. We still have a series of higher lows, and now we have a series, once again, of a new higher high. And that is not necessarily a bearish situation. What changes that is if we start to see a lower low, right? Boom. And then a lower high. And that could identify potential changes in trend on the larger term time frames. If we take a look at SPY, we measured this kind of cup with handle pattern over here a while ago. And when we started seeing some strength on this day, we started talking about potential measured moves. And that would take us into and at around 620 on the SPY, and we're really not too far away from it. In fact, the quarterly expected move is at 615.52. We still got the month of December to close out. So up into this range, if the SPY comes up here, I'd be just very cautious in and around those specific levels, given the context that this is what the market priced in for risk for this entire quarter, and we're kind of nearing those levels. So let's take a look at the current market conditions. What is taking place and how do we specifically navigate the markets, understanding what those conditions are. So if I take a look at a net gamma chart, you can see that traders are reaching up to that 6,100. It has been that 6,000, then it was 60.50, and they kind of fluttered back and forth, but traders are still reaching up further. So the big levels to really watch here is 6,100, because if we come up to these levels, this is where price can get obviously pinned in and around, just like it did at 6,000. And just like it did today at 60.50. Now, if it starts breaking its intermediate support of 60.50 or can't get above it, start paying very close attention to 6,000 because there's not much going on underneath it. And that's where things could get quite wild. More specifically, if you want to look at the gamma flip line, as price has been pressing higher, the gamma flip line has been following it up. And the gamma flip line tells us when these conditions of the market can change, right? Dealers, when we're above the gamma flip line, dealers look to buy the dip and sell the rip, and volatility typically comes in, which, by the way, we're going to be talking about volatility in a moment. But when we start getting below the gamma flip line, this is where selling can beget selling, buying begets buying. Volatility typically increases, which we've shown on prior episodes on the VIX chart of what that looks like. So right now we're kind of floating around that 60-50, and we have 6100 in the targets, not too far away. So if price starts pressing up higher, your reward gets a lot smaller, where the risk to the downside grows exponentially. So just be aware of that. Now, if we look at the trend changer over here and the 5-day moving average amongst the SPY, the Qs, IWM, semiconductors, XBI, and DIA, green, 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 green. That's 6 screens. So we're bullish across the board. We're above a gamma flip line. These is bullish conditions. So it's not necessarily a time to say, hey, yeah, I'm going to start building up a short position as the Qs are breaking out. But it is a time to be very cautious as we're reaching into these specific levels, and the risk and reward levels start to skew themselves quite a bit. Now, I want to hop into some of the expected moves. For the S&P 500, this week we are looking at about a $6.89 plus or minus expected move. We saw a little bit of an uptick today. We do have a new monthly expected move. So the monthly expected move is above the quarter to date. So we're looking at, up here at around 622.50 and 582.50 for the month of December. So chances are we'll close within this range. Now to be fair, what I was talking about earlier, right? Would we actually come all the way off and not make a 20% gain this year? Well, in order to do that, we'd have to crack through the month-to-date expected move and almost do a 2 standard deviation move on the month. So it's fairly rare, not impossible, but it is fairly rare. So this week, we're still well within the weekly implied move. We have upside to and around 610. I'm just rounding right there. If you want the exact levels, I post them in the Discord channel, which we can talk about a little bit later. I usually share them here, and I think I did bring them up. So give me a second here. There we go. Okay. So if you want the exact levels on the SPY, 609.44. Beneath us for the weekly expected move is 595.66. Going into tomorrow's trading session for these intraday traders over here, we have the red zone up here. This is the daily implied zone. It's utilizing the daily expected move for 0-date options. And it's also taking a calculation from where we currently stand on the VIX, which basically implies about a 0.83% daily implied move as where we currently stand on the VIX product. So if we come down into here, we'd still be above a rising 5-day moving average. If we start breaking down from here, start paying closer attention to the weekly expected move. Now, the Qs made a pretty significant advance today, almost to its upper weekly expected move. So if the Qs, right, consolidated, hold at its week-to-date anchor volume weighted average price, if it wants to press up here, just be aware that if we get into these levels, we'd be outside of the weekly expected move, we'd be near the daily. So things could get a little bit hung up in and around these areas where it's likely to see them kind of trying to doodle around in its kind of happy place if that were to occur. If it were to come off, pay attention to the inclining 5-day moving average, the lower daily implied zone here. And then if we start bouncing, just pay very close attention to the month-to-day anchored volume weighted average price, which is also the week-to-date and it's also the daily. But this is a new month and you want to pay attention to where this is and where price is. When we're above it, that'd be bullish for the month. But if we start getting below it and it starts declining, that could be a bearish case for the month. Now, as the Qs made their advance, I want to call out a couple of names that have already reached their implied move for the week. That would be Microsoft. So Microsoft saw a nice big move. Its implied move was $8.40. It does not mean that it can't go through it and further, but look at how it went through it today and came back in. So that has reached its implied move for the week. And then we have Meta. Meta saw an explosive move today too on some strong volume. It's right there at about its weekly implied move. So just be careful if you're executing new positions with these type of names after they've made an aggressive move and they've went above what the market was already pricing in for risk. As far as the other Mag 7 stocks, they haven't tagged their weekly expected move, but I'll make sure to talk about it when they do. If we take a look now at volatility, I did find this chart to be pretty interesting. When the line's up here, it's showing a hedge fund short VIX exposure and their long exposure here. So I wanted to call this out because if they are shorting the VIX from where we currently are, think about covering. What happens if the VIX is down, right, which it is, and they start to cover and the VIX starts to obviously rise. So this right here could be a potential contrarian indicator showing us that saying, hey, where we currently stand with the VIX might be a time to just be a little bit more cautious in the near term. And you can see this here on skew. Think of skew as just hedging protection, right? The higher this goes, we're looking for the dealers, traders are looking for protection. And you can see over here, we're at 167.5, which is a rather high reading. So what is that, right, telling us? It's telling us that there's a lot of protection being bought. And if you take a look over here, this is back month, first front month volatility. And we are getting now above this 20% marker. And the times prior that we did this, the market typically starts to settle in and calm down. Not all the time. Like, for example, over here, you could see that the market, it did settle down, but we ended up resolving higher. In the more recent ones over here, the market did come off a little bit. Over here, the market did kind of went up and then kind of came in a little bit. And you can go back through this chart and you can see it came in. Over here, we chopped around a lot. It actually kind of digested here. We went up, we digested more, and then we started retracing for about a 10% correction. So we're getting a little extended there on volatility, or back month, first front month volatility. Sentiment indicators, they're getting pretty darn frothy too. Are we actually starting to get some thinner air up and around these levels as we move into 2025? At minimum, I don't think it's I don't think it's the time to potentially, get all bared up, but I think it is a time to just be a little bit more cautious. And that time really, really should be amplified when the market conditions begin to change. And once again, those market conditions we talk about on this episode. So if you haven't subscribed to the channel, make sure to do so, because I talk about these almost every episode. That's about the gamma flip line, when we start crossing under and when we start to see these declining 5-day moving averages. Hope that helps out, give you some insight into the market. See you on the next.